Hello and welcome to episode 39 of the Wealth Amplifier podcast. Aaron, Pat, hello. Say hello to the listeners.
Hello.
Hey, everybody. I feel like it's been a while.
It has. We've had a few guests in recent episodes, and we have some more guests lined up, but we figured it was time to get the three of us back together on one of the few days in the month of July that we're all around.
Good to be here. Happy we're doing it.
Yep.
So I guess before we start, travel plans. Aaron, you want to lead us off there?
Greece. Greece is coming tomorrow, actually. Some big birthdays in our family, so we're celebrating with a trip abroad. My wife's been wanting to go for a while, as have I, so looking forward to it.
Yeah, and I think we'll get to it later in the podcast, but we have a bit of a crypto section. But now that you're officially mature as well, you've joined me in the club. Pat's going to have to lead the way in the crypto discussion. But before we get to that, Pat, what do we have on the docket first today?
So we were kicking around what to discuss. There's, I guess, like any time this year, it seems like there's been no shortage of headlines. But more specifically, there's been a lot of legislative activity for anybody who gets updates on their phone from news sources. A lot of them do impact our industry and our clients around financial planning, investment planning, tax planning. So it just felt like they were all sort of in the crux of items to discuss. So it sounds like we'll probably jump into one or two of them more than all three, but the three big ones that have been surfacing and the three of us have kicked around there's been a lot of discussion and I guess an executive order signed on the allowance of more alternative or esoteric investments in traditional 401k plans, retirement plans. There's been a whole bunch of stablecoin cryptocurrency legislation that just passed recently that you alluded to, Matt. And obviously, we finally have received some clarity on tax legislation for the year, which was a big one that's been up in the air and we discussed a couple months ago. So those are the big three, the core three.
So do you want to hit the 401k and alternative investment topic first?
Yeah, I think there's a lot to dissect there.
Let's just sort of set the stage.
Right.
401k plans, typically, it's a very vanilla menu that your employer sets. So, hey, all employees, here are 12 or 15 typically mutual funds or index funds that you can choose. And if you have some questions, call the 1-800 number, call your advisor. It's very hands-off, very high level. They don't want to blow you up. They want to give you with down the middle investment options. Frankly, to not get sued. That's what the employer wants. So now the introduction of alternative investments looks like it will be happening. They talked about specific alternatives or really just private equity.
So just to set the stage, and then Matt, if you want to jump in here on some thoughts, but I think, and correct me if I'm wrong here, basically Trump signed an executive order which allows 401k plans to include more private market stuff like private equity, venture capital, private real estate, crypto, whole bunch of that broad spectrum alternatives. That doesn't mean that plans are now mandated to include any of that stuff. It's going to shift, I guess, legislatively to like the Department of Labor and the SEC to issue more guidance, but just to set the sort of legal stage.
Yeah, so I think it makes a lot of sense on one hand. And if you look at institutional investors' asset allocations, college endowments, pension funds, et cetera, they're pretty heavy into what are broadly called alternative or even private investments. Those are slightly different categories, but there's a lot of overlap. And the individual investor ranks are really light in that area. So it makes sense, as you know, we have a different, seemingly, I'm sure while we're sitting here on this podcast, we will get an email from some sort of private asset manager trying to get us to look at a strategy for our clients. And we see a ton of them. So this is sort of the wave, it seems, of the present and the future, but it has some pretty decent pros and cons. So I have some thoughts before I dive in. What was your knee-jerk reaction? Was it like, this is great, this is terrible? Where did you come out?
This cannot end well, in my opinion, for non-private equity. Let's just stick to one asset class. Let's just say private equity. It could be hedge fund real estate, but it's called private equity. The private equity industry might like it, but I don't think this can end particularly well or will end particularly well for the end investor. And we can go into why, but that was my initial reaction.
But let's go into the why. You think that's mostly because it will the investments will be lousy, people will misuse them. Like, what do you think will happen?
All of the above. So try to think of which one to hit first. A long time ago, you could invest in, you still can, invest in real estate and other private assets within 401k plans. And a lot of that blew up because a Vanguard, a Fidelity, a Schwab, whoever that 401k provider didn't want to say, hey, here's the value of your real estate anymore. And people were getting into all sorts of tax trouble and investments going bad that they were holding in the retirement account. I think what's going to happen now is it will be more standardized, more oversight. You're going to have the big guys offering their private vehicles in retirement plans. When I say the big guys, it's the Blackstones and the Carlyles and the KKRs and the Apollos. And they are building and have built these instruments for the masses. So you could have a flood of money coming into these private equity vehicles. But now that those private equity vehicles now need to find a home for those dollars. Where are we going to invest? So if everyone's chasing the same nut, and there's only so many, but the mandate is I'm making it up from Apollo, we'll say, everything's getting gobbled up, but they need to put that money to work. They might now start buying things that are suboptimal, things that they shouldn't really be buying. So I think you sort of have a decrease in performance overall from where private equity has traditionally been. And those are the big guys. I think there's going to be way too many then small guys chasing and saying, hey, I want to be in that space. We're bringing money in. They're unscrupulous and not doing the right thing and not let's say fraudulent, but I think you're going to have some of those investments blow up where really your 401k should be generally safe. Like I said in the beginning, the employer wants to give you a menu. They're a fiduciary, do everything you can to not get sued and keep employees happy and safe. And now we're going to be putting all this other stuff in there that really shouldn't be in there. I think there's just a lot of reasons why this might not go well.
Yeah, I mean, there's a lot to unpack here. The more you think and talk it through, the more you turn over stones and have like more to dissect. I think to your original question, Matt, I have a bit of a hedged answer. Like knee-jerk reaction is I'm cautiously optimistic, but maybe to add some context to what Aaron's saying too, like historically, let's continue to use private equity as the example. Historically, it was an asset class, an investment class that was reserved for the most sophisticated of investors, institutional pension funds, endowments from universities. They had access to invest in private companies first. And really, it's that sort of, there's been two trends, I think, that are worth noting that have kind of converged on where we are today. One is that traditionally or historically, those endowments, they buy up these private companies, private investments, and at some point there would be an exit. And a lot of times those exits, meaning the ability to sell that company, would be via a public market, not an IPO, right? And those have sort of dried up a little bit. We've talked, any private market asset manager will tell you there's far fewer companies trading publicly than there used to be. There's a lot more companies that stay private for longer because there's a lot more sort of ecosystem and capital available in private markets than there ever used to be. So, okay, you got on one side, the institutional investors have sort of been tapped out. Like all these private equity managers, they've gotten sort of their quota filled from all these institutional investors. And at the same time, there's less of an ability to sell the end investment because public markets are less of a viable option. So where I come on this is sort of my negative perception is retail investors, which is really what Wall Street is now trying to target with some of this 401k rollout. Do they become like the bag holders, right? Because now all these private equity managers, they need exit strategies. They need to find new capital so that they can pay back their big institutional investors. And if they can't go sell all these companies publicly and IPO them, where's the money coming from? So I think in one case, this is sort of the again, negative perception or sort of the if you wanted to be a little bit scrupulous on why this is happening, it's private equity companies are going to need money to sell their investments, and someone potentially gets caught holding the bag. And two, they're always looking for ways to make money. We always talk about Wall Street is a genius at finding ways to make money off products. Here's a new way for them to make a lot of money off products, especially while traditional ETFs and publicly traded securities have gotten cheaper and cheaper and cheaper and cheaper for the retail investor. So those are sort of my I'm a little concerned about how this is all developing and why. I have some positive thoughts too, but let me stop there.
Well, then I'll take up the mantle of the positive side because I have a couple, and all of your concerns, both of you, are valid. There are a lot of potential issues with alternative investments. But one of the biggest pain points for a lot of our clients that do invest in alternative investments, and I understand that our client mix doesn't necessarily look exactly like the mix of a 401k investor, but there are a lot of large balances in 401k plans. And one of the pain points is they can be incredibly tax inefficient investments, both from a tax cost perspective, the distribution of gains, income, all that kind of stuff, and then a tax operations perspective, K1s, delayed filings, revised K1s, all kinds of fun stuff. So to the extent that a client is going to own private assets anyway as part of their allocation, if we take the standpoint that I think Blackstone and others use, that private equity is really just another form of stock ownership, private credit, another form of bond ownership. And to Pat's point, there are far fewer publicly traded companies now, more of them private, so on. So if private's going to be a part of your allocation, probably a 401k where you don't need liquidity, generally speaking, and you don't have to worry about taxes, generally speaking, because it's all deferred, is a really good place to hold them. Now, that is a biased answer from our side of the table. I understand that may not work that well for every single investor in every single 401k plan. And then one other knock-on effect that I wouldn't necessarily say is negative or positive, but just kind of interesting, is if this works, and chances are, if I had to guess, this is a sign maybe of a short-term, I wouldn't say top, but we're getting a little frothy when we're clamoring for private equity and 401ks. But over the long term, if this works, that's a lot of money going into these private pools. My guess is that privately owned companies now will have a whole lot more suitors and buyers. And I wonder, to Aaron's point about the credit terms, also on the equity side, what that does to valuation of private companies. I was talking to a person we know who owns a private business, and he's like, wow, there are going to be a lot of buyers out there if this works, and that should drive up prices. So that's just sort of not necessarily a positive or a negative, but maybe a different slant on it.
Yeah, I mean, I would agree. In the whole, if you simplify this whole conversation, the allure of private assets in general is that they hopefully can return or potentially have higher returns than public markets. So that would be a good thing. If everything pans out historically in a perfect world, the average investor, all of us who have 401k plans, do we get to participate in better returns and less volatility?
I'm curious to see how it actually gets implemented, because as many of our clients know, those who participate stay in the private equity world. It is not fully liquid. You can't buy today and sell tomorrow. Maybe there are some instruments you can. I'm sure there are. But typically, it's either I'm investing in a one-off fund, and it might be a 10-year deal, and you can't get out. Maybe you can here and there, but you're really in for 10 years. And there's other versions where you can get in and get out quarterly or semi-annually or annually. So what's the vehicle going to look like that can go into a 401k, and the average American that participates says, oh, I'm going to go invest in this thing, but now I need money to live off of. I'm retiring. I want to do a rollover, and I'm stuck. So are these going to really be fully liquid investments? And how can they be? Because if we'll call it Blackstone this time. Blackstone takes all that money and plunks it into private companies, and a whole bunch of people want their money out at that moment. They can't just start selling private companies and real estate and all the like. That is why typically maybe there's quarterly liquidity or annual, or only a certain percentage of a fund can be sold on the whole, so they don't have a run on the fund and have to sell their investments at the wrong time. So it'll be interesting to see how they do this. I'm sure in those private vehicles, there's going to be a lot of public stuff and a lot of liquid stuff, which could help the performance. Look, if you're investing 80% of the fund in the private markets, but they need to leave 20% of the money in cash and treasuries and things like that to provide liquidity, well, now you only have 80% of your money invested, and the performance is going to suffer,
right.
Could suffer, let's say. So it's going to be a lot of administrative hurdles and headaches, I'd imagine.
Sure.
To get started.
And I'll throw another one out there related to that. Traditionally, private investments come with certain thresholds that you have to meet to be able to invest, whether it's accredited investor standards, the higher qualified purchaser, and there's that one in the middle that I always forget, qualified client or something like that. But anyway, these are standards that you have a certain amount of wealth, certain amount of income, maybe even a certain amount of sophistication to invest in these vehicles. Are we going to get rid of those standards, or only people inside of plans that meet those standards going to be able to invest? Then does that cause other discrimination issues inside of 401k land? And again, I'm not being negative on it. It's just, I think these are just open questions.
Open questions for sure. My guess is, at least on that last one, Matt, since 401k plans are regarded as like their own trust entity, maybe part of this executive order, or the way the DOL interprets it, is that 401k plans are themselves accredited investors, or whatever the case is. And then that's how.
But if the heart of the issue really is, hey, mom and pop, that's the investor, we don't want you to get into this one investment that is maybe too risky, too esoteric. But now you're part of a big group, so you can just jump in like everybody else. It could be hairy.
Yeah,
I'm sure there's going to be a lot of changes to come and a lot more color, because we don't know a lot yet. But
yeah, I'll throw one more in too. Again, we're being somewhat negative. I do think there are some positives here, but again, as you keep unturning rocks here, like more issues pop up. My guess is this is just a complete hypothetical, but more to your point, Aaron, of fiduciaries in the 401k plans, they have to try and make sure things don't blow up so that they don't get sued, right? So what is that going to do if there's now an advent of alternatives? Well, predominantly, if I'm a fiduciary in a 401k plan, I'm choosing, the most reputable firms. So the Blackstones and the Apollos and the KKRs and the Carlyle, those are the groups that I'm going to choose to have a alternative investment relationship with, which is good and bad, I think, for the alternative investment landscape, right? Because that creates a whole bunch of companies that are, dare I say, too big to fail, just like we've seen in previous financial system episodes. And that sort of, like any industry, it goes against some of the innovation of new entrants and smaller boutique investment managers that might actually be able to source better deals or better things for investors, but they may not have access. Again, that's a complete hypothetical. It's down the rabbit hole, but there's a lot to unpack, obviously.
Yeah. And I think on the fiduciary side, just, I guess, on the flip side of that, what if, let's go back to 2008, public markets got absolutely decimated. I think from late 07 to early 09, S&P 500 was down over 50%. Now, plenty of people owned S&P 500, either funds or things like them in 401ks, and I'd hardly call their results safe if they went down 50% over 18 months.
Right.
Because private investments sometimes are less volatile, they don't mark to market as much. What happens if in that scenario, the private investments are riding through reasonably unscathed and you didn't offer them to your employees and they're sitting there owning the S&P down 50%? I could see that coming back to bite employers. That's
a whole other topic that we've talked about a lot is, are they really just as volatile, but they aren't priced? It's like ignoring Zillow and the advent of technology on your to value your home. You don't walk outside and see a value of your house every day.
That's right.
So, yeah, is it just as volatile? Well, maybe it has to be priced every day because it's liquid for participants of a 401k to be able to sell. And how do you, steel manufacturer, how do you value them on a daily basis?
Right.
Don't know.
Well, we could talk about this one for a whole episode, but in the interest of time, since we're at about the 20-minute mark, Pat, as the youthful member of our crew here, can you explain to us what a stablecoin is, why this should matter to us and to the listeners and that legislation?
Yeah, I'll do my best. We've never, the three of us, myself included, as even the younger of the three, I've never been like a huge bullish cryptocurrency person necessarily. I haven't paid attention to all the market mechanics of cryptocurrency the way some investors do. That said, what caught my eye on this whole topic is just that it seemed like it was such big news. Like it was getting a ton of fanfare and press and all that kind of stuff. So anyway, as I understand it, stablecoin basically is like a digital store of $1, more or less. So it's probably not a perfect example, but one I think our listeners will understand, and the three of us will understand, is if you have an investment account and you have a portion of your money in cash at any given time, you might want it in a money market fund, which underneath the hood of a money market fund are U.S. Treasury bonds and other safe, stable value assets. Stablecoins are essentially the sort of digital cryptocurrency version of that. So if you need to keep your money tokenized, you're in cryptocurrencies, but you're not looking to have it in the Bitcoins and the Ethereums and all the other meme coins that are out there these days, because of the volatility that's associated with those other assets. A stablecoin will provide you essentially a sort of cash-like instrument. And until this legislation was passed most recently, as far as I know to date, it has not been a regulated part of the financial markets. Much like anything in cryptocurrency, it's been, the Tether, I think, is the biggest provider of stable coins. And they had, I think, their own enormous issue a handful of years ago where, they had a run on their stable coins. And as, the investors peered into what was actually backing them, it wasn't just US Treasury bonds, it was other assets that were not as stable. So this, in, I guess, a nutshell, there are other components of this that it creates both state and federal regulation, depending on the size of the stablecoin issuer, to make sure that the stablecoin is in fact backed by an asset mix that is perceived to be stable and safe in a very, very sort of high level nutshell on how this works. And it provides a whole bunch of framework for the issuers and new entrants to the markets and all this kind of stuff. So that's kind of the top to bottom, super high level summary of what's going on in this arena.
I know people rely on us for as their financial mavens, the people that hire us day to day, but I'm still lost on this one a little bit. So I feel badly saying it, but
that's all right.
It's tough to grasp. It's tough.
Yeah, it is. Matt, do you have any? I can frame this a couple of ways for us, but do you have any sort of knee-jerk thoughts on the whole topic?
No, well, knee-jerk. Look, I think, like Aaron, I am not a guru on crypto, but this isn't an advice pod. Those are one-on-one conversations. This is just us talking about things. So I'll give you my knee-jerk response. Crypto was supposed to be this like new exciting thing.
Right.
And also like totally decentralized from the government in any way, shape, or form. Now we're going to attach them to the government in effect. Like, it feels contradictory to me as a novice, not knowing what I'm talking about.
No, I think that's been sort of a reasonable argument for a lot of people. I think where I think it's interesting for our world and just for, I think, anybody, whether you're a cryptocurrency fan or not, is what I think the bill aims at, and I think the Trump administration has been pretty vocal about, is like, okay, is the idea of blockchain for the financial system, is it going to have major use cases in the future, right? So is our financial system going to have a larger share of transactions that occur digitally as opposed to over traditional ways like wires and transfers and EFTs and bank-to-bank transfers and all this kind of stuff? And really that is what blockchain allows you to do, right? You can transfer money instantaneously. And I think for those that believe, and I don't know, I don't have a strong opinion on this, but like anything, as technology revolutionizes industries, this is sort of the potential that the financial industry may take a step in this direction, that there will be more use case for cryptocurrencies on a large global financial scale. And if so, yeah, to your point, Matt, like it does take away from its original, I think, thesis, but you have to have some regulation of it. You have to have big players involved to make sure that it actually works accordingly. So this legislation, right or wrong, is, I think, a step in that direction. That if you believe the blockchain technology is viable in our financial system, this would be a way to start to bring, credibility to it.
I don't disagree with that. I think the regulation's important, and some of the criticism is it'll stifle, the new entrants, but you can't have it be the wild, wild west. Because as I was reading one of these summaries, it was like, oh, and it needs to be backed by, I don't know, these algorithms. And then in parentheses, like, this algorithm is now defunct. So what, did everyone lose their money? You can't have that happen. Right. You can't have everybody lose their money in something that was supposed to be stable.
Right.
So yes, put some regulations and then kind of foster and nurture the new entrants in a safe way.
Right. The other thing, and then I think we could probably move on from this one because it gets very rabbit hole itself. But the other theme that I thought was sort of interesting of this is like most of these stable coins have US dollar backing, right? So the assets underneath the hood are backed by US dollar denominated assets, US Treasury bonds, et cetera. And this whole year through 7 months, there's been a big theme of like US dollar depreciation, which is sort of opposite of some of Trump's intended policies, I think. But, is that a good or a bad thing? This has been a conversation in our world for a while is, does the US dollar ever lose its global dominance? And that's sort of shown its head a little bit this year. And to me, this would be a move for right or wrong again, if cryptocurrency and stablecoins are going to be a part of a larger financial framework system and they're all backed by US dollars, that helps buoy the sort of dominance of US dollar globalization. So I don't know if you guys have any thoughts on that, but I thought that's sort of an interesting trend and theme as well with what's been going on all year.
Yeah, I think that's definitely a point of this regulation to, again, help the US dollar and the backing of it. So yeah, that makes sense.
I think we did a decent job on the big, beautiful bill before it passed. I guess just maybe one headline that I would highlight, it passed. Yeah. So that uncertainty is gone, for better or worse. You can love it or hate it, but it's no longer, an open topic. And that was sort of my biggest additional takeaway because, we spent a decent amount of time on debt and taxes and so on the last episode. You guys have anything else on the bill?
No, I think you're spot on, Matt. I think we'll likely, obviously, one-on-one be talking to clients a ton about
sure.
But the bill and how it affects them personally, and we'll likely have more podcast or newsletter type information on the bill itself as we get closer to year end. But we at least have clarity in that whole picture.
So I think what the listeners really want is a Hoagie review. And I think I know the man who has one. So you want to take it away with a Hoagie review there, Aaron?
Buckle your seatbelts. I'm going to give you two. It's a twofer. It's a twofer today. So I got to give you the backstory. It's going to take me a few minutes. I'm going to go through it with you. Stereotypically, financial advisors have few hobbies. And I'm Mr. Stereotype. Fishing, fly fishing, you can see on my wall if you're watching, and golf. So pertains to the story. So I meet at our golf club, I meet a friend of my wife's father, retired, gets into fishing, this and that. And we go fly fishing last year and, you're chatting all day. And we do it again a couple weeks ago. This was before July 4th. You're in the car for an hour, you're fishing for several hours. So, you just get into different conversations. So he goes down the shore a lot. Somehow the podcast comes up, somehow Hoagies come up, and he goes, "Oh, do I have a place for you?" And he says he's down in Margate. So I figure he's going to say Dino's. And you already know my opinion on Dino's from a previous episode. He goes, "No, I got two for you. Sugar Hill Sub and Delis, and not a lot of people know it, which is in Mays Landing, and Pete's Subs and Deli, which is in Egg Harbor. So both down the shore, same general neighborhood. And actually, which one was it? Pete's, the word is people left White House in Atlantic City, which is one of the meccas of Hoagies, to Pete's. So those are the two he starts telling me about. So he goes, "I'll tell you what." And coincidentally, we're supposed to be with each other 2 days later at this golf tournament where you play with your partner or spouse and you have dinner afterwards. He goes, "Well, I'll see you in a couple of days. We'll talk about it then." So anyway, the next day he texted me. He says, "I'm going to bring you the sandwiches. Tell me what you want. If you don't like turkey or Italian or whatever," I say, "Get me whatever you want, oil and vinegar, get whatever seasonings you want. Let's do it." So that morning, I don't know the exact timing of how this is all going down. Is he bringing him to me? And am I having him in the parking lot? Is it in a cooler? Am I going to have him the next day? Because you can't have a cold hoagie. So it's about noon. And I text him. I say, "Hey, what's the story? What's your timing?" He goes, "I'm bringing him to the club. I'm going to put him in a fridge in the kitchen with your name on it." I say, "Okay, great." So I figure I'll have him the next day. So we play golf, and afterwards there's supposed to be a dinner with all friends and people that you're hanging out with, and it's a buffet. You're not really supposed to be bringing your own food. So I tell him, I was like, "No, I'll get the hoagies. I'll have them tomorrow." He goes, "You're not having them tomorrow. You're having them tonight." I said, what do you want me to do? I can't just bring them out and eat hoagies in the on the patio with all these other people. And he goes, tell him you want the hoagies. I'm like, all right, fine, I'll make him happy. So I go tell this one woman who's a manager there. I said, look, there's 2 hoagies in the back. She goes, I know your name's on them.
Dude, you got a hoagie VIP treatment.
Oh, yeah.
Wow.
Yes. So, well, from her, she was like, we'll cut them up. We'll bring them out. I'm mingling around. I mentioned the word hoagie, and it's like a moth to a flame. There's like 12 guys like hoagies. And, and now there's a buzz, there's a stir so much that the head manager hears. He's not happy. You can't have hoagies. You can't bring your own food. We can't do this.
Oh boy.
Anyway, we smooth it over so that they bring the hoagies out. They chop them up into 8 pieces. I got 7 people all trying different ones. So we got them served on platters. I wish it was a hoagie that would blow you away, because I thought the story was good. However, the hoagies maybe didn't follow in that same path. So don't get them mixed up. So Sugar Hill, they've been around since the 80s. As word goes, it's fallen off a little bit. So I didn't do the order, as I mentioned, and he did want to shout out Bob Dubin. So thank you, Bob, for the hoagies. And Mainline Metals, if anyone, for your metal and scrap metal needs. I don't know exactly.
What are we sponsored now?
Yes, well, now we are. Paid in hoagies. So he said he was only going to bring me the hoagies if I gave him a shout out.
There you go.
So it was mediocre. It was mayo. I'm not a mayo fan. It was a whole thing. And the crowd who was trying them as well, they were underwhelmed. So Sugar Hill, we're going to put it a 6-7. Not somewhere I'm going to need to seek out. However, Pete's, again, not an order I would have done myself. Looked like the turkey was going to be dry. It was not. It was a much better roll. Again, they come from White House. Everyone likes the White House rolls. That was more 8-1. And I'll tell you, it had room to be a lot higher on the 8s if I probably did the order myself. But 2 good spots. Pete's definitely better than Sugar Hill. But if you're looking for something off the beaten track down the shore for a little adventure, give them a try.
All right. I may be down there later this week. So maybe a little road trip to the mainland and see if we can get one.
Wow. The story was exciting.
I wish I had a better ending, blown away, best thing you ever had. But you don't know where the path takes you.
That's right.
You don't know where the hoagie story goes.
Look, you have to commit to the process. You got to trust the process. That's what you're doing as our hoagie connoisseur. And you can't control the outcomes. You just have to give it as they come. So I respect
and maybe a sneak peek for those of you who don't follow us on LinkedIn and Instagram and all the other places. I did get 2 requests for a Peter Luger's in Brooklyn review. And for those who didn't see, Matt and I completely coincidentally ran into each other at lunch last weekend. Super bizarre. So we'll have to touch on that at some point.
Yeah.
One of the weirder run-ins I've had, given that neither of us knew we were even in New York, let alone at the same restaurant at the same time for lunch. It was strange. All right. Well, I guess before we wrap, any recommendations in terms, not stocks and bonds, we don't do that here, shows, books, podcasts, other things you're listening to or reading or watching?
I'll let you guys go first.
I'm pretty boring, actually. Recently, the 3rd season of Squid Games on Netflix came out, and I'm a big fan. Anybody who's thought about getting into it or watched the first season, didn't get back into it, it's been just as good. Like, the level of consistency season to season has been premium content. So almost done with that, enjoying it. And then Kara and she has never seen the full series, just started Sopranos from the beginning. And what
do you think?
Well, I've seen it before, and this is the second time I'm watching it through. It's just as good. Like it holds up so well. The first season is obviously quite a ways long ago from where we are today, and I'm thoroughly enjoying it. It's excellent. We're like almost done with season 2 at this point.
And just for the listeners, so we don't leave them with a cliffhanger, you broke up a little bit on the first recommendation. Season 3 of what?
Squid Games on Netflix.
I thought that's what you said.
Yeah.
Sure. Okay.
Sorry. Thanks for clarifying.
I haven't been watching anything that good. There are a number of shows I've seen that are pretty bad, but I won't. I'll stay positive. I'll give a book, and actually, I gave it to Aaron yesterday for his trip to Greece. The recently much covered Jake Tapper book, Jake Tapper and Alex Thompson from Politico. their coverage of the Biden decision to run, decision to drop out, the backstory. It was I thought it was really good, really well done, good reporting, and really an exceptionally bad period, regardless of your politics. Just that we wound up in this situation, and I shouldn't use that passive a voice. People allowed us to wind up in a certain situation that I don't think they should have. But I'll let you read the book and judge for yourself.
Yeah, I appreciate the book, and I actually brought a few books, so I'll have some book recommendations on our next podcast. I did watch The Residence on Netflix, Shonda Rhimes' show. It's a murder in the White House. It sort of reminds you of Clue, the movie from way back. Really witty, sharp, funny. You don't know who did it at the end until the very last episode, kind of thing. So that was a fun one if anyone's looking for a good summer show.
So that's like a 1-season limited series type
Yeah,
thing?
I don't know if there will be more, but I think it was, call it 8 episodes, all released at once on Netflix. It was good.
Great.
Check
All right. So I think that's a wrap for episode 39. If you missed episode 38, I interviewed Casey Jorgensen, executive at Dynasty, who gave a pretty good breakdown of the wealth management industry. And we have some more guests coming up soon, and we'll be back together, I assume the three of us, after Greece. So enjoy your trip, enjoy the remainder of summer, and we'll do another one soon.
Thanks, everyone.
Awesome. Thanks, guys.